Important mid-cap stock is the new listing, that's Talwalkars. I think the market was factoring in a 20 rupee uptick, so about 15 rupees up. Not bad for Talwalkar this morning. Anand Gawande, CFO of the company, joins in to talk about more on where the business may be headed. Anand, thanks for joining in. You will be at more liberty now to talk about the kind of growth you have penciled in for the company. What's the revenue target that you've set for FY11, both on the top line in terms of sales and what that translates into in terms of profits for Talwalkars?
Good morning, Mitali. Good morning, Sonia.
Hi.
Yeah, thank you to all the shareholders who have made this possible, the listing. It's a wonderful day for us. I think I can be at a little more liberty today than I was about 2-3 weeks back when I met you and Uday and Mitali. Our current estimate is that we'll close the year with a turnover of about 0-10. We should close with a turnover of about 70-72 crore, with an EBITDA of about 22 to 23 crore. And a PAT of about 8.5 crore. This is the year which went by, Mitali. In the current year, we expect the turnover to be between 120 to 125 crore, with a EBITDA of between 38 and 40 crore, and a PAT of between 18 and 20 crore. What really will happen, if you remember my earlier chat with you, is the IPO money will mean the health club will open only in the last quarter of the current year. So the full year impact will be felt only in the next year, for which year we feel that we should be able to do a turnover based on our expansion just now of about 185 to 200 crore for 0-12 March, a EBITDA of about 57 to 60 crore, and a PAT of about 30-32 crore rupees. This is for 0-12 March.
Yeah. Anand, for the current year, FY11, if you do go on to report about 20 crores in terms of profits, what would that mean in terms of an earnings per share? Because I think most analysts are working with slightly lower estimates for you right now.
Yeah, there are two factors, first of all. One is we will be saving approximately 2.5 to 3 crore rupees, Mitali, of interest cost, because some of the loans are getting repaid through the IPO proceeds. Maybe that is one of the things which has to be factored into the PAT for the current year. Number two is that 18 to 20 crore PAT figure which I have given to you should give us an EPS of about 7.5 to 8 on an equity of about 24 crore rupees. So that is where we think we should be for the end of current year. There are two critical reasons for it, Mitali. We opened 7 gyms or 7 health clubs in the month of March 0-10. We are opening 11 more in the next couple of months and 27 in the last quarter of the current year. The combined impact of that should take us to that turnover and profitability.
Anand, morning. Just talking a little more about the kind of gyms that you plan to open in the next couple of years. Could you tell us exactly how much by way of a margin are you expecting to hold across the board in the next couple of years, and what is the average margin that you're targeting?
So we are usually been revolving in a margin of between 29 to 34.5%. We believe that in the current year, the year ended, which is 0-10, we should be doing a EBITDA of about 33-34%. Even in the current year, which is 0-11 March, our expectation is between 33.5% EBITDA and about 14% PAT, 13.5-14% PAT is what we expect to be at, maybe 14.5%. This is led by two reasons. One is our gym or per health club profitability is treated as each individual health club profitability, and it usually does not change too much. Number two is the break-even does not take too much time to achieve, because whichever cities we have been going into, whether it is Jodhpur, Jabalpur, Banaras, and we will be going into a lot of more cities. We should be at about 48 to 50 cities, I think, Sonia, by the end of this year. The response has been absolutely fantastic, and I don't see a problem on break-even. The moment we do break-even, the EBITDA accretion becomes immediate.
But you were speaking about the FY12 estimate on the PAT front at about 30 to 32 crores. That's a significant jump from here on. Could you tell us per gym how much are you expecting the weighted revenue to increase?
Sure. First, I'll tell you why the figure comes to 30-32 crore. Actually, by the end of 0-11 March, we should be able to have 82 gyms within the company, health club. Our weighted average revenue per gym is about 200 lakhs. So about 165 to 170 crore of our turnover is secure in March 0-11, April 0-11 itself. Then there will be expansion which will take place for the year ended 0-12 March. That expansion should be able to take us to a turnover of between 185 and 200 crore. That's point number one. Point number two is per gym, we do a bit of, as I said, 200 lakh is our ballpark benchmark turnover per health club. There may be some which are lesser, some more. This is the benchmark weighted average. A 33% EBITDA on that is a 66 lakh rupee EBITDA, and a PAT of about 15% of that is between 28 and 30 lakh rupees. So that's approximately how a gym will pan out, or a health club on an all India basis.
Assuming you go on to do that 30 to 32 crores in FY12, Anant, and your equity base remains the same, what do you think your earnings per share could scale up to from the current 7.5 to 8 rupees that you're projecting for this year?
This indicates, Mitali, that we should be able to do a EPS of approximately 13, between 12.5 and 13.5 on a 10 rupee share for the year ended 0-12 March is our own feeling right now, is my own guess, our own team guess. And I think the unrolling of the 27 health club, if it is on schedule, which it should be, because we are obviously searching for properties all over India, and some of them will get closed pretty soon. I don't think that there should be a significant problem in doing that kind of pattern of 12.5, 13.5 EPS.
We wish you luck, Anand. Thanks very much for stopping by today and speaking with us. That Talwalkars has picked up a little bit ever since you heard the management talking about their guidance. 7.5 to 8 rupees in this year, which means the stock is trading at about 19 times at 150. But more importantly, if they do go on to do about that 13.5 as they indicated, it means the FY12 valuation for the company actually comes down to about 11.5 times or so. Of course, PEs are not the best way to value some of these companies, but that doesn't look screamingly expensive.